Are leases perfect? This is the Issues Watch podcast. Hello and welcome to the Issues Watch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm an assurance principal at Clifton Larson Allen. Back with me today is Matt Charney, audit director at CLA, and Marissa Flood, an audit senior at CLA. Welcome, Matt and Marissa. I had to wrestle this chair back away from you. We're looking a little too comfortable here, okay?
I know.
I'm not liking that. I gotta separate the two of you, too. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. A quick disclaimer, the views and statements expressed herein are our own and not necessarily those of NJCPA or CLA. Okay, I said perfect at the beginning. I was talking about the post-implementation review. Now, what I've noticed a lot is that's, like the key phrases that are out. We were talking about before, lean in, lean on, all this heavy lift, stuff like that. Well, the FASB, AICPA is doing these now, a lot of post-implementation reviews, PIR. Effect, that's what I was going with, but post-implementation review. So I wanted to do our own kind of little post-implementation review. So, when they do it, they do statistical studies, and my statistical study is what's going on up here, okay? But what I would like to hear from people that actually watch this, I'd like to hear any comments you have on your implementation or your client's implementation on leases, RevRec, and Cecil. Okay? Was it 326?
326 is
Oh, wow, that was a good guess on my part. So, leases, RevRec, and Cecil. So if you have any comments, email any one of us, because we're going to try and accumulate some of the comments and then talk about them another time. Right now, we're going to talk about leases. So, real quick history, ASU 2016-02 came out, and of course, 2016. It was delayed due to COVID. Public business entities had to adopt it right before COVID, and then COVID hit, and then private companies, non-public business entities, got to put into effect in 2022. Okay, it in effect replaced FAS 13. I know the two of you going FAS 13. What the hell is it?
Seeing 1973 right over here.
Seeing a date that predates me by 21 years.
21 years, really?
Yeah.
I was 8 years old at the time, and I was reading the FASBs then too.
Oh yeah, light reading for grammar school.
Right. So it replaced FAS 13, and lessors were largely unchanged. Yes, there is some stuff in there, so if you are a lessor, please look into it, but it's largely unchanged. The big change that came from, and I know you guys see this, and I'm hoping that everybody else remembers this, is that the operating leases are on the balance sheet now. They never were before.
Nope.
And we stopped calling them capital leases. Now they're finance leases. Okay? And they changed the 5 steps that you have to go through. Now, when I was studying for the exam, the mnemonic that we had to learn was 2BOP 7590.
Okay.
Okay? Yeah. 2BOP 7590. Transfer of ownership, bargain purchase option, 75% of the useful life, and 90% of the fair value.
Oh, I
2BOP 7590.
Okay.
So they got rid of, for as example, because now they changed a little bit, they don't say 75% of the useful life anymore. They say substantially the useful life.
Right.
As an example, 75%. It says
75%. I was gonna say
So, for the
that
most
number
part-
hasn't left my head either.
So for the most part, the 2BOP 7590 is still around. Okay, and then there's another criteria, but just remember that. And there's significantly different disclosures now. In the past, we used to just have to disclose the lease commitment, and that was it. Everything was done.
Right. These days, there's a lot more policies that go in the footnote.
A lot more.
Yep.
They have the policy, and then you have the whole commitment area. Yeah.
The risk-free rate, that was a new change this year.
Yeah, that was a big one that came in too. I mean, we got into a big debate because you can either use the rate that's explicit in the lease, which in my career, I don't know if you've seen any.
Once.
Once you've actually seen it.
Yeah, yeah.
Really?
It's really tied more. The lease was really structured more like a loan for equipment, so it was
Okay.
a finance lease. But at the end of the day, that was the only time I've seen that. And it was structured like more of a loan, so they were making payments that included interest and things like that. I believe where you were going with this is that the risk-free rate is used the other 99% of the time, which is when you would say, well, I have a lease, but it's just an operating lease. I don't have any interest payments.
Right.
So what interest rate am I supposed to use? You'd go to the treasury rate or the risk-free rate.
Yeah, now, there was a big discussion. I actually had a discussion with a member, and I do believe he watches it, and he and I had a difference of opinion on one thing. You can use an implied rate. So if you are leasing a car, and it doesn't give you the rate, but you know if you bought the car, it would be 4.99%.
Right.
You can use that. If you have another, but if you're going, whatever interest rate you're going to use, risk-free rate or an implied rate, you have to use it for those class of assets. You can't say for the Maserati, I'm going to use this 4.99, but for the Yugo, I'm going to use the risk-free rate, which is less. Okay, because
Yeah.
so you have to use it for the same class.
Yeah, much like a lot of accounting, your policies that you elect have to be consistent.
Right.
So whatever you elect, like you said, for the class of assets, that has to be uniform. You can't.
Okay.
You can choose to get your favorable rates.
And now somebody said, well, for a car or even an office, you can just use your line of credit rate. And that was their opinion. My opinion was, and this is my opinion, is that you have to use a rate that's similar to the term of the lease. So if you have a 10-year lease, you have to use the 10-year risk-free rate.
Right. Right.
And my problem is line of credit is usually short-term, maybe 2 years. So if you have a lease that's short-term for 2 years, okay, great. But if it's short-term, then it doesn't apply anyway.
Yeah, yeah,
You
makes
can
sense.
elect out of that.
A short-term expense disclosure. That's all you need.
Yep. Yeah. So, what you're gonna say something about it?
Well, no, yeah, I was just gonna kind of go into the leasehold improvement.
Oh, leasehold
But
improvements.
I saved that one because I know that's a big topic you like to talk about.
What do you? Well, what's the change as it relates to it? Do you know? Or
Well, you can do it over the life of the
related parties.
The related party leases. So.
Yeah. So, yeah. Well, so here's one that really annoys the heck out of me. Okay, you know this one annoys me
Please.
because when FAS 13 came out, you know, when we all grew up with, you had to do it over the shorter of the life of the asset or the life of the lease. It's very straightforward, and you got your hand slapped and you got yelled at, and how can you not even think about this? How can you not think about this? And then all of a sudden they say, well, if it's a related party lease, you know, private business entities can do this. If it's a related party lease, you can do it over the life that they are using.
What kind?
I've been in this profession since 1988. Why did it take them, and this was in 22, so why did it take them how many years? I can't do the math that quick. 34 years? 34 years in my lifetime, my professional lifetime, for them to figure this out.
Yeah.
Okay? We've been saying stuff like this as accountants, saying, address this. And then I know that you attended the convention last year, and there was a great presenter there, and we brought up during one of the sessions,
Yeah.
why didn't they just scope out related party leases in general?
I still don't know why.
And so, have you dealt with consolidating information?
Yeah, a little bit. I'm just starting to this year kind of deal with it, and it's
So,
What do you see in there?
oh,
Oh.
it's an exercise in mathematics. Because if you do consolidated financial statements and it's related party leases, they get eliminated.
Okay.
Right?
Yeah.
They get eliminated.
I would think.
Right, but wait. You do consolidating information. It's by columns now. Each company's supposed to be under GAAP. That means you have to put the asset on the books of the company on the consolidating schedule, and then eliminate it. So it's an exercise in mathematics. That's all it is.
Right.
Yeah.
Right. Because you're going to put something on the standalone just to get rid of it when you consolidate.
yes.
There we go. Now, what I've seen, and what I recommend to people, is your consolidated is correct because it's eliminated. You're on the consolidating, do not put it into effect there, and just take a disclaimer on the consolidating. I've seen that. I don't know if you've seen it yet. If you haven't seen it and you want an example of I've seen it in a review and I've seen it in audits. That's one thing I recommend. Because, as I said, we asked that presenter, why didn't they take this? Why didn't they scope out related party? And do you remember what their editorial comment was?
I do. Again, disclaimer, these are our own views. This is just an opinion. But the comment that she relayed to us was that the FASB is so stuck in the academics of it that they don't really pay attention to the actual application within the marketplace. So from an academic standpoint, how could you scope out a related party lease? There's a whole lease I owe money to this other entity, and that's something that needs to be disclosed, and you can't just ignore that.
Right.
But in the business place, you're paying yourself 90% of the time. And the terms of the lease are whatever you want them to be. You want it to be $1, it could be $1. You want it to be $1 million, it could be $1 million. It doesn't really matter. 'Cause at the end of the day, it's taking money from your left hand and putting it into your right hand.
Right. If they go refinance the lease, the loan, they're going to just change the lease. Whereas our third party lessor, they're not going to change the lease.
Yeah.
The landlord of our buildings are going to say, oh, I got a great deal on my mortgage, and guess what? You're going to save too.
Nope. I've never seen that
I'd
happen.
like to live under that landlord.
Yeah. Quick question for you, because I know you deal with the clients a lot and you talk with the clients a lot. What do the clients think about this?
Honestly, some of them don't even know what it is. Some of them, no, I'm kidding. Some of them just don't. They don't understand why there's a big asset sitting on their books at this point when, you know, it's been there for years. They don't love it. It's a building that they've had.
Mm-hmm.
They account for it. They just close it. They don't need it on the books. I don't really have many positives.
Okay. I appreciate how she's holding back right now. Give her a few more episodes.
Yeah.
She'll be ripping into
Yeah.
No, that's what I've seen too.
It's
Most of our
tough.
clients aren't accounting for it and
Yeah.
then have us adjust for it at the end of the year.
Yeah, and
I agree.
I think it's, you know, it's good to kind of walk through with them to kind of show them
Right.
what you're doing and why it is on the books. But at the end of the day, it's really not something that
I agree.
is
I've seen a lot
driving
of-
the financial statements.
A lot
for
of
them.
very similar reactions, getting phone calls when I send the financial statements in draft form for review. People call and they say, I have one question. What is a right of use asset?
Okay.
Where did it come from? And then we have to go through the whole exercise again of, well, it's, you know, from 842 and through your leases, it's representative of the ability to use the building that you are operating in and so on and so forth. So what I find helps a lot if you're getting a lot of similar reactions, which I suspect a lot of the listeners are, is to actually send the clients the amortization schedules to view
Right.
after they're created from whatever system you're using to generate that. And it becomes a really easy tool to show them, here's the schedule of payments, it shows you the asset that's going to be on there, the related liability, makes that conversation go a lot quicker.
Yep. So before I get to the closing, I'll give one philosophical question for I want you all to think about. No comments.
Mm-hmm.
Isn't every asset a right of use? I think I have the right to use the cash. I think I have the right to everything. So, all right, let's go to, in closing, here are some upcoming accounting and auditing events. There's a 4-hour webinar on April 21st, the bottom line on the new lease accounting requirements. It's very timely. And a 2-hour webinar on April 24th and May 12th, exploring the new lease accounting standard. And Frank Boulet and I will be presenting a 3-hour A&A update May 9th with a replay on May 16th. Get info on these events and more at njcpa.org/events. And of course, be sure to join the Society's Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/groups. Thank you for watching or listening.